Great. Now, what is different in laser, which we haven't covered in other questions? Have a look at the whole story about dividends and share capital. And then also here we have vehicles, which is presented at net book value. So there's no breakdown between cost price and accumulated depreciation. So that's an example of how to handle with the account, which I don't have the breakdown, and what should I do then with that account. Okay, the following information relates to laser for the year ended 31 August 2016. They give us a statement of financial position, land and buildings, machinery and equipment, accumulated depreciation, machinery and equipment, vehicles at net book value, investment in B in F Bank. Important, there was a huge reduction in the investment, don't forget about that. Then inventory, accounts receivable, cash and cash equivalents. On the equity side, we have share capital. Now, if it's only share capital, it means ordinary share capital. 10% convertible preference shares, share premium. Oops, look there. Revaluation reserve, land and buildings. Last year, nothing. This year then a cool 1.6 million, so that means that was the transfer that we made to this reserve account via the other comprehensive income section in the income statement in the current financial year. Then retained earnings, mortgage bond, accounts payable, shareholders for dividends and SARS dividend withholding tax. Now this one, remember, shareholders for dividends will be those two balances together, opening balance, and those two balances together being closing balance. Rent income received in advance. Now, rent income is a separately disclosable item, and some of that income has been received in advance. Bank overdraft, current portion of long-term debt. Now, remember, when we're going to talk about long-term debt, I have to add the long-term portion with the short-term portion for the account balance. Long-term portion with the short-term portion for the account balance, and then SARS income tax payable. Now, out of the statement of profit or loss and other comprehensive income for the year, they gave you quite a comprehensive income statement. Revenue consists out of sales and sales returns. Then I have cost of sales, which consists of opening inventory purchases less closing inventory, gross profit figure. Other income is the gain on the sale of equipment, rent income, and interest on investment. Separately disclosable item, separately disclosable item. Expenses, interest on the mortgage bond, separately disclosable item. Loss on the sale of a vehicle, other operating expenses, profit before tax for the year was a cool round 2,361,000. Then tax, and here's our reval of 1.6 million again. Additional information. You can accept that the cash paid to suppliers and employees amounts to 8,795,000. Great. Then we have information on dividends. At the beginning of the financial year, it was approved that 60% of the dividend owing to our shareholders as of 31 August 2015. So that will be our opening balance of our shareholders for dividends. So those two together. 60% of them was settled through a capitalization issue of ordinary shares at R6 per share and the remainder in cash. The shareholders and the South African Revenue Services were both paid on 20 September 2015. Dividends declared at the end of August will be paid in October. Then share capital, they give us the authorized share capital. We have 1,010% convertible pref shares at R2.25 per share. Issued share capital, we have 3 million ordinary shares issued and 600,000 convertible pref shares issued at R3.20 per share. So that ordinary shares means it's no par value shares. Here's a nominal value attached to the share, so that's par value shares. And then going back to your statement of financial position, it also then explains why we have a share premium account. And so that share premium account belongs to our 10% convertible pref shares. At the beginning of September, the company was given approval that 50% of the 10% convertible pref shares to have to be converted into ordinary shares at a conversion price of R6 per share. At the end of August 2016, an additional 395,000 ordinary shares were issued. Then property, plant and equipment, there's some information there, and then the required part. Prepare the statement of cash flow using the direct method, including the reconciliation note for Laser Limited for the year ended 31 August 2016. Show the calculation for cash received from customers. A balancing figure will not be accepted. So what they tell you there is you have to do the reconciliation note, and in the question, if you can remember correctly, they gave you that cash paid to suppliers and employees was 8795. This is once you've done the reconciliation note, to what figure do I actually reconcile to? To cash from operations. So if I have cash from operations and I have deducted cash paid to suppliers and employees, then the balancing figure must be cash received from customers. So they say that's not the way to go. If you want to do that, you still have to show me how that figure of cash received from customers was actually being made up with. So not as a balancing figure. Okay, now let's start our cash flow statement with cash received from customers. We have a revenue figure, and here it is all about total sales for the year. 13,600. That's the one that you're going to use. And then you're going to adjust against that the movement in trade debtors for the year. And here they have accounts receivable. There's nothing funny about trade debtors. So I can just take that increase of, 12,000 Rand to account for our cash received from customers. Let me just move this thing. It's a little bit out of balance. Right. Cash received from customers then is our revenue of 13.6 million Rand. Our movement in debtors is the 164,000 less the 152,000. Those two there. And that gives us then an increase in debtors, which represents an outflow of cash of 12,000. So cash received, 13,588,000. Cash paid to suppliers and employees was given to us, so we can just plot it down, 8795. The difference between the two is net cash generated by operations. So let's stop there and let's start doing the reconciliation note. Now, because a lot of the non-cash flow items is actually in our property, plant and equipment accounts, let's then do our property, plant and equipment accounts first. Land and buildings. Opening balance, 18.5 million Rand. Closing balance, 24.1 million Rand. We've also seen that there was a revaluation of land. So on the debit side, revaluation account, 1.6 million. Then in our statement of profit or loss, we see that we have here a gain on the sale of equipment, loss in the sale of the vehicles. So there is nothing about land. And then here in the property, plant and equipment section, during the year equipment, that is all about equipment, and then the vehicle, and then depreciation is included in other operating expenses. So obviously there's nothing more about land. So if we have the opening balance, the closing balance, the revaluation reserve, then it means that the balancing figure must be equal to new land and buildings acquired to the value of 4 million Rand. Once you have determined that, you go to your cash flow statement and you're going to dump it there where it should be. Cash flow from investing activities. Purchase of land and buildings for expansion purposes, 4 million Rand. Then we are done with land and buildings. Let's do equipment next. Go back, you look at the opening balance and closing balance. They gave it to you here in the statement of financial position. In the cost price, 8.9 million opening balance, closing balance 10.5 million. Accumulated depreciation, opening balance 1950, closing balance 3.2. 8.9 opening, closing. These are opening balance, accumulated depreciation, closing. Then they tell us in our additional information that during the year, equipment with a cost price of 200,000 and accumulated depreciation of 140,000 was sold. The equipment was replaced and 1.5 million of equipment was purchased for expansion purposes and was installed in the new building. Okay, now first thing first, let's dispose of this asset first. We're going to take out the 200,000 out of the cost price, dump it in the realization account. We're going to take out 140,000 out of the accumulated depreciation and dump it in the asset realization account. There's the 200,000, there's the 140,000. Going back to your income statement, gain on the sale of equipment is a profit of 10,000 Rand. So in our realization account, profit on the sale, 10,000 Rand. We balance this account off and we see that there is going to be proceeds that we've received of 70,000 Rand on the equipment. Take that proceeds and we're going to dump it immediately in our cash flow statement. Proceeds on the sale of equipment, there it is, 70,000 Rand. Going back to our equipment account here, they don't tell us anything further than the gain on the sale. What they do tell us is that 1.5 million Rand worth of equipment was purchased for expansion purposes. So when we go to our equipment account, the cost price account of our equipment, we are going to have a balancing figure on the debit side of 1820. What they actually tell me is, I'm going to do it like this, that you can see that that first 1.5 million Rand was for there. And that amount there is going to be different. There you are. So the total amount of the balancing figure, which they haven't given you, is actually only the 320,000. They gave you that there for that 1.5 million. That was actually then, there it is, for expansion purposes. So that means that the remaining 320,000 must have been for replacement purposes. So in your account, you could have split it, you could have kept it at 1820, but then remember, when you've completed this, 1.5 will be expansion, 320,000 will be replacement. Just get rid of that. So then in our accumulated depreciation account, when you balance it off, you're going to miss something on the credit side, which will be your depreciation charge for the year on equipment. I haven't given that to you, so you can work it out as the balancing figure. Our vehicles, that's the next one. Vehicles, that only gave us the net book value. So you're going to open up one account for vehicles with an opening balance of 2550 and a closing balance of 2270. So here's our vehicles. Opening balance 2550, closing balance 2270,000. Then in our additional information, they tell you a vehicle with a cost of 160,000 and accumulated depreciation of 120,000 was sold. So what was the book value, the carrying value, which was transferred to the asset realization account? 40,000 Rand. So I could have taken out the cost on this side and drop it down, and the accumulated depreciation on that side and drop it down, but the net impact is still the carrying value of 40,000, which was going to take out of this. Remember, that is now at net book value, 40,000. When we go to our income statement, you will see that there was a loss on the sale of the vehicle. There it is. And that was 8,000 Rand. So in our asset disposal account, a loss of 8,000, so we can work out the proceeds on the sale of the vehicle being 32,000 Rand. So that 32,000 Rand we can take directly to our cash flow from investing activities. Proceeds from the sale of the vehicle, 32,000 Rand. Whilst we are on this thing, don't forget about our investment. So let's jot that down. Here was investment in BNF Bank. There was a reduction of 350,000 Rand. So we received our investment back. Decrease in investments, 350,000. Great. So now we've handled everything that has to do with our PPE. So let's then do the reconciliation note. The reconciliation note will start with profit before tax, 2,361,000. Then we're going to adjust it, number 1, for non-cash flow items. Now, in our PPE accounts, we have quite a number of them. Let's have a look. We have here loss on the sale of a vehicle of 8,000, non-cash flow. In our vehicles account, which we haven't completed as yet, let's just quickly go to vehicles. We haven't done everything about vehicles. During the year, there was a replacement of vehicles of 240,000 Rand. So when I said we were done, we were not done. There is a replacement of 240,000, and that 240,000 was also part of my investment activities, purchase of the vehicle for replacement, 240,000. Now we've done everything. Now, the loss on this one we've done, that one we've done. If we now balance off our vehicles at carrying value, if we balance off that account, we need a credit entry on this side to make the account balance. Now, the only thing that can be is the depreciation expense for the year. Remember, it's a combined account. We have purchases, we have the carry value of the assets that's sold, which was removed out of the account. So the only other thing that can happen in that combined account is our depreciation charge for the year. And that is actually our balancing figure of 480,000. So total depreciation will then be our 480,000 plus 1,390. So in total, non-cash flow item of 1,870,000. So there's the depreciation, the 480,000 and the 1,390. Then loss on the sale of the vehicle, 8,000. Profit on the sale of equipment, 10,000 Rand. 8,000, 10,000. Then adjusted for items disclosed separately. And where do I find those items in the income statement? So if I look at the income statement, rent income, we're going to disclose it separately. We have to take it out of our profit. Interest on investment, we're going to take that out of our profit. Interest paid on the mortgage bond, we're going to take that out of the profit. It seems to be all then. Interest received, 25,000. Interest paid, 620,000. And rent income, 42,000. Remember, what do we deduct here? The items which was included in profit before tax. Not another figure. We are busy adjusting profit before tax. Therefore, we can only add and deduct items which was included in that amount of profit before tax. Then changes in working capital, guys, that is straightforward. Inventory, there was a decrease in inventory, so it's an inflow of cash of 18,000. Debtors, remember we are doing the reconciliation note. The debtors we've already done as a matter of fact, so that was then that increase of 12,000 Rand, which is an outflow of cash. And then trade creditors is the other one. That is an increase of 5,000 Rand, which is a cash inflow. So that will give us then cash generated by operations, 4,793,000. If I go back to my cash flow statement, you'll see indeed it balances back to 4,793,000. Now, our separately disclosable items. They tell us here accounts payable, dividends result, rent income received in advance, 24,000 at the beginning of the year, 22,000 at the end of the year. So you will have to make or open up a T account for rent income received in advance, with an opening balance on the credit side of 24,000 and a closing balance on the debit side of 22,000. Then you're going to take your income statement where you're going to populate your rent income for the year. So rent income for the year, 42,000 Rand in that account as well. Just see if I can find that account. Yeah. Opening balance 24,000, closing balance 22,000. Rent income as per the income statement. This is my income account, 42,000. So when I balance off this account, it means I have actually received rent for the year for 40,000 Rand. So yeah, separately disclosable item, actual rent received. Okay, it's not rent income, rent received. Okay. Then interest received. Well, nothing happened. I don't have any further information on interest. So therefore here in my, again, rent income, interest on investment. So it's investment income, 25,000 Rand, which is that 25,000 Rand. Dividends, let's just park dividends for the moment. Interest paid. Now, there was also nothing more about interest. So interest on the mortgage bond paid, 620,000. That is that amount there. And then tax paid. Well, tax is also quite straightforward. We had an opening balance of 121,200. So it's the 121,200 plus our tax of 661,080 in the income statement, less our closing balance of 94,500, and that will give us actual taxation paid for the year, 687,780. Right, now over and above for the dividends, we have done everything in this section. We have done everything in the investment activity section. So let's move to the financing activity section. Now let's do the easy one first. The easy one is our mortgage bond. They don't give us any further information, so we must just purely work on the movement in balances. So what you should have remembered is to add the 4680 plus the 520,000, and then you would have subtracted it from the 5562,000 plus the 618,000. And that will give us then an increase in the mortgage bond of 980,000. Shares. Now let's read dividends first before we get to shares. At the beginning of the financial year, it was approved that 60% of the dividend owing to the shareholders at 31 August 2015 has to be paid through the capitalization issue of ordinary shares at 6 Rand per share and the remainder in cash. So what that is all about is our shareholders for dividends account at the beginning of the year. Where are you? Here we have shareholders for dividends, so it's all about those two figures that we have there. Opening balance, shareholders for dividends, and SARS withholding tax. Opening balance, the 2450 plus the 432,450. Now they say 60% of that amount was settled by ways of a capitalization issue and the remainder was paid in cash. Shareholders and the South African Revenue Services were both paid on 20 September 2015, so the cash flow has taken place. Dividends declared at the end of the year will only be paid in August 2016. So that means also by implication that this outstanding balance here at the end of the year will be then, has not yet been paid, And that full amount there has either been paid by way of a capitalization issue or by cash. Then if we move, just keep that for the moment in the back of your mind. Then they give us share capital and they say issued share capital on 1 September 2015, so the beginning of the year. 3 million ordinary shares, so in our ordinary share capital account, we are going to open up with a balance of 17,720,000. Ordinary shares, opening balance 17,720,000. Then immediately at the beginning of the year, the capitalization issue took place. And that capitalization issue was the 2450550 plus the 432,450 multiplied by 60%. So if we go to our shareholders for dividends account, we would have seen there's our opening balance, the two of them together, that 60% of that was the capitalization issue. So 60% of our opening balance, which consists out of those two balances, was then capitalized by ways of ordinary capital. So I have debited my shareholders for dividends account with a 1,729,800 and I credited my ordinary shares of 1,729,800. Now you can work out here the number of shares which was issued. I don't actually need that in this question, but I might have I could have told you that at the end of the year a dividend of X cents per share was declared, and then you had to work out some of these stuff. So it opened up with 3 million shares, and this 1,729,800 divided by the issue price, which was 6 Rand per share. That would have given you the number of shares which was issued. Great. Then, furthermore, what happened to our shares for the year? Also, at the beginning of the year, the company was given approval that 50% of the 10% convertible pref shares were to be converted into ordinary shares at a conversion price of 6 Rand a share. Now, we had in issue at the beginning of the year 600,000 convertible shares issued at 3.25 Rand per share. But that's its par value shares, and the par value was 2.25 Rand. So you will see that the difference between the 3.20 Rand, the issue price, and the 2.25 Rand, which was the par value of the shares, multiplied by the number of shares, actually give me that amount of share premium, the 570,000 Rand. So if I go to my 10% convertible shares, the opening balance in the capital account was 600,000 shares at 2.25 Rand, 1,350. In the share premium account, I would have had 600,000 shares at the difference between 3.20 Rand and 2.25 Rand, which is 95 cents, which would have given you the 570,000. 50% was converted in ordinary shares. So I had to take out 50% out of the opening balance and transfer that to the ordinary shares. And I had to take out 50% of the share premium and transfer that over to my ordinary shares. So when I work out what was the number of shares, I don't need it in this question, but I could have needed it, then it would have been those two together, which looks like 960,000 Rand, divided by 6 Rand a share, so that given me 160,000 shares. So if you look at your closing balance of your convertible shares, it's 675,000, and the closing balance of the share premium account is 285,000, which will balance back exactly to what you have on your statement of financial position. Good. Then they also tell me that at the end of August, an additional 395,000 shares were issued. Now, that means that there was an additional share issue, and they don't give me the proceeds of the share issue. So the whole exercise here is to determine what is going to be the value of the share issue. Going back to my statement of financial position, I know that my closing balance on my ordinary share capital account is 22,779,800. So the 22,779,800, and that means that my balancing figure equals the proceeds on the issue of shares, 2,370,000. So under my financing activities, proceeds of the issue of ordinary shares, 2,370,000. Going back to where I still haven't completed dividends paid. Now, dividends paid, we said our opening balance was 2,883. We settled 60% by ways of a capitalization issue. So 40% of that amount was settled in cash, which is 1,153,200. Now, the dividends for the current year. Now, guys, here it was accidentally equal to the closing balance, but it could have been something else. Just to check whether there was not additional dividends declared for the year, you must have done your retained earnings calculation. So my retained earnings at the beginning of the year was 846,300, and at the end of the year it was 168,024. In this question, only the profit for the year could have affected retained earnings. So if I go to my profit after tax for the year, 1699920, that would have increased my retained earnings. So then the balancing figure would have been my dividends declared for the year, which is 2,378,196. 2,378,196, which is equal in this question to the same closing balance that you have, the closing balance being here, shareholders for dividends, where I've added the two together, those two figures together. That gives me that amount of 2,378,196. I could have given you a different closing balance, and then that would have meant that you had to do this calculation to derive at that amount, and that would have meant that from this closing dividends, I could have paid something for the current year. So if I have omitted in this question, this little sentence, that dividends declared at the end of the year, where are you now? Dividends declared at the end of August will be paid in October 2016, which is the next financial year. So I could have omitted that. I could have let you calculate a final dividend because I gave you all the shares. Or alternatively, I could have just kept quiet and gave you, my voice doesn't want to do it anymore, and gave you a different closing balance there. And then you would have meant that we have paid something of those dividends as well for the year. So going back here, the amount paid then for the year was only the 40% pertaining to the opening balance. And that you will include in your cash flow statement here, dividends paid 115,200. Now I can complete this section. Total cash flow from operating activities 239,720. I can complete this section. Total cash flow from investment activities 5608. I can complete this section 3350. Now cash and cash equivalents is just purely what was our opening balance of cash and cash equivalents, which they gave us. I had an overdrawn balance 16,500. It increased to a positive balance of 122520. So if I add the two together, there was an increase in my cash of 139,020. Now I can check 239,720 minus 5608,000 plus 3350 equals 139,020. The B part of the question, which is important, asks you, in your opinion, did the company manage its cash resources wisely during the year? Comment briefly. Now, if we go to our cash flow statement, let's just look at the story that it is telling us. They say that there's a huge positive cash flow from operating activities, 2.4 million rand close to. But we have spent in increasing, there's a lot of expansions here as well, our investment activities to the tune of 5.6 million rand. We have funded that with 3.3 million out of financing activities. But that means then by implication, we have used a lot of cash from our operating activities to fund our financing activities. There's just a little increase in cash and cash reserves at the end of the year. Is it wise? Well, that remains to be seen. You also see here that dividends was paid during the year amounting to 115,300. We also declare dividends for the current year of 237,896. But if you go back to your income statement, your profit after tax is only 169,920. So what did they do? They actually dug into the retained earnings reserves for the year, and they have repaid out of their retained earnings. Look there, profit for the year 1699. They declared 2.4 million worth of dividends. So they actually wiped out, to a large extent, the retained earnings for the year. And that, I don't think, is a very clever thing to do. So go and have a look at the answer yourself. You can work through the answer. There's a couple of pointers that I gave you in the answer, and make sure that you understand what I'm telling you in that answer.